Hey, it's Darius. And what do you think I'm predicting as the #1 reg topic to know for 2021? Like-kind exchanges. Why? In a year of so many changes, the CARES Act changing the NOL rules and the charitable contribution rules. What the exam usually does in that situation is they'll test you on some of the more complex topics that have not changed. And that leads us right to the doorstep of a like-kind exchange.
And this topic is always tested. Why? Because the exchange of like-kind investment property is normally viewed as non-taxable, but there's always exceptions, and it's these exceptions that they like to test. So with like-kind exchanges, there's calculations, there's analysis that needs to be done, and that's what makes for a perfect CPA exam question. What there is not is memorization. And I know that Becker and some of the others try to push memorization in this area. Don't try that. You need to understand what's going on and why. Because there's 5 issues with regard to like-kind exchanges. There's the amount realized from the exchange, which means what did you get out of it? Then there's the basis of the old, what you got rid of. And those two will determine your realized gain. The gain that you would have had you sold the property instead of exchanged it. But then there's the recognized gain. Now there might not be any recognized gain, but there might be, especially if there's cash received in a like-kind exchange. And then there's the basis for the new asset, the asset received in the exchange. So with all that going on, that's why they like to ask about like-kind exchanges. It should be easier because all you're doing is exchanging land for land, any type of real estate for any other type of real estate, rental house for an apartment building or a commercial building for a warehouse. You do that, you qualify for a like-kind exchange, and whatever gain would normally be viewed as non-taxable. So why is it not that simple all the time? Because in some like-kind exchanges, you might be doing land for land, but an item that is not like-kind may also be received to even up the trade. And this additional item is commonly known as boot, and it's often a cash amount, and it's receiving boot that creates a potential taxable gain for a like-kind exchange. And the taxable gain is always the lower of that boot received or the realized gain or any accounting type gain on the exchange. So let's look at our first example. And as we go through these, it's always the same idea. We need to know the amount realized, the basis of the old. The two of these will compare, and the difference between them will be the realized gain. Then we'll analyze to determine the recognized gain, and then we'll analyze again to determine the basis of the new asset. And that's why there's no room for memorization here. Start with something basic because that's the I-75 way. First we walk, then we walk a little faster, then we run, then we do backflips. So here's our first example. A taxpayer holds investment land with a basis of $30,000, fair market value of $40,000. So that means if we were to sell this right now, we would probably make $10,000, but we're not going to sell it. We're going to exchange it for like-kind property, so other type of real estate, with a fair market value of $36,000, and that doesn't exactly match up with the $40,000 that our property's worth. So to even up the trade, we're going to receive cash of $4,000, and it's that cash that's going to create the potential taxable gain. So step 1, we need to look at the amount realized. What did we get out of this exchange? We got $36,000 worth of a new property, plus we got $4,000 in cash. So our amount realized is calculated this way. $36,000, the fair market value of what we got, plus $4,000 cash equals $40,000. The previous basis was $30,000. They told us that. So our realized gain would be $10,000. So if they asked us what our realized gain, we'd say $10,000. But you don't pay taxes on a realized gain. You pay taxes on any recognized gain. So now we have to analyze. The recognized gain is the lower of the realized gain, which is $10,000, versus the $4,000 cash boot. That's what's taxable. So that means we would report a taxable gain of $4,000. So 4,000 would be our recognized gain. Now for the basis of the new, we have to analyze again. Since all the boot is being taxed right now, we're being taxed on this boot right now at $4,000, the basis doesn't need to be reduced. So we're going to get the new asset, and what's our basis going to be in it? The same as the basis in our old asset, $30,000. As long as all the boot is being taxed right now, the basis doesn't change, doesn't go down, and we don't want it to go down because you never want to reduce your asset's basis because that's going to create a gain later on. So if you thought that you had to lower the basis right now from $30,000 down to $26,000, by doing that, you'd be taxed on this $4,000 twice. Once now, and once when you went to sell the new asset. So why does the basis not change? Not because we're memorizing a formula, but because all the boot is being taxed right now. All $4,000 of cash boot is being taxed today. So it doesn't have to be taxed tomorrow. So leave the basis the same as it was. It was $30,000 for the old. It becomes $30,000 for the new. All right, let's look at the second example. And it's very much like the first. We're going to change only one number. A taxpayer holds investment land with a basis of $39,000 instead of $30,000. Fair market value is the same, $40,000. So if we went to sell it right now, we'd realize a gain of $1,000. But we're not going to sell it. Once again, we're going to exchange it for like-kind property with a fair value of $36,000. But that's not equal to the fair value that we're giving up. So we're asking for some cash. And they're giving us cash of $4,000 to even up the trade. Typical in a like-kind exchange question. Very much like what we just saw. The only difference is the basis of our old property, instead of being $30,000, is now $39,000. Same 5 issues. Number 1, what's the amount realized? What's good for us? What's good for us is the $36,000, the fair value of the new property, plus $4,000 cash, or $40,000. That's the amount realized. That's the amount we realized from the exchange. We compare that to the previous basis. It says it's $39,000. So then our realized gain is $1,000. But we don't pay tax on the realized gain. We pay taxes on the recognized gain if there is any. The recognized gain is always the lower of, in this case, the $1,000 realized gain versus the $4,000 of cash boot. The lower of those two is taxable. So this time, our taxable gain would be $1,000, whereas last time it was $4,000. This time we're only being taxed on $1,000. That's our recognized gain. Why? Because we analyze, and the lower of the realized gain, which is only $1,000 this time, or the $4,000 cash boot, is what's taxable. So our taxable gain is $1,000. Okay, now we have to analyze again because we need to come up with the basis for the new. And the question is all the boot being taxed right now? No, it's not. The boot we received was $4,000 in cash, and only $1,000 of it is being taxed right now. Only $1,000 of the $4,000 cash boot is being taxed today. So the other $3,000 will be taxed later. Because the IRS looks at it and says, you just put $4,000 cash in your pocket in a like-kind exchange. We saw you put it in your pocket. And we're not going to tax you on the whole thing right now. Only $1,000 is being taxed right now. So the other $3,000, we're going to tax you on that later because you're not getting away with that $4,000 cash that you received. So even though you're not being taxed on it now, doesn't mean you're getting away with it. You're going to be taxed on it later. And the way we'll guarantee that you'll be taxed on it later, we're going to take your basis down by $3,000 from 39 down to 36. So the basis of the new property will be 36,000. And not because we memorized something, but because we analyzed. We said if all the boot is being taxed today, then don't take the basis down. But that's not what's happening here. Only $1,000 of the $4,000 boot is being taxed today. The other $3,000 has to be taxed later. And the way we're going to guarantee that is we're going to take the basis down. So lower the basis by the amount of boot that is not being taxed today. In this case, $3,000. So the amount realized was 40. The previous basis was 39. The realized gain was only 1,000. The recognized gain then became only 1,000. The lower of the realized gain versus the cash boot. And then the basis of the new became $36,000. We had to reduce the old basis by the amount of boot that is not being taxed right now. All right, how's it going to look on the test? Just like this. They're going to tell you in a like-kind exchange, Andrea exchanged commercial real estate that she owned for other commercial real estate. The following additional information pertains to this transaction. Calculate her realized gain. So they give you the property given up. They give you the property received. And there's even some cash boot that she received. So the first thing we got to do is just what we know. Calculate the amount realized. What's good for Andrea? Well, she got new property worth $450. She also got cash of $50,000. So the amount realized is $500,000. That's not the realized gain, but that's the amount realized. Compare that to the basis of the old, given at $300,000, and so she's got a $200,000 realized gain. Answer choice D. Okay, now we always anticipate the next question. That's the I-75 way. So now they're going to ask what's her recognized gain on the like-kind exchange. We already know what the realized gain is. What's the recognized gain? And we pick up right where we left off in the calculation. Now we have to just analyze. We know the realized gain is $200,000. The recognized gain will be the lower of the realized gain or the boot received. In this case, the cash boot, $50,000, would be the recognized gain. And the answer is B. What else can they ask you with the same set of facts? What's Andrea's basis in the asset received in the like-kind exchange? And once again, we pick it up from the same calculation just where we left off. So $200,000 was the realized gain, $50,000 was the recognized gain, and to analyze the basis of the new, we want to know, is all the boot being taxed now? If so, the basis stays the same. So all $50,000 cash boot is being taxed right now. In that case, the basis of the new is the same as the basis of the old, and that would be $300,000, and that's letter C.